Thanks, Angie, and thanks to all of you for coming today and for staying this late and listening to me. I hope I can give you some good ideas and some things to work on. So I'll be talking about angel investors and also quite a bit about the New Ventures competition. Just by way of background, like many of you, I was and still am an entrepreneur. I was an engineering student at the University of Waterloo back in the 70s. Those were the days when you didn't have excellent grades to get in, so I was lucky I got in because it was a young institution and they would take just about anyone, and happily they took me. And so while I was there as part of a fourth-year project, I developed video display terminals, and these were the days before desktop PCs. You can see some of our renderings there. They look like desktop PCs, but desktop PCs hadn't been invented then. In fact, IBM didn't come out and introduce the IBM desktop until 1981, and this is back in the early 1970s. In fact, the microprocessor wasn't even invented by Intel until 1971. So a lot of these devices were basically random logic, but long story short, we built up an international business. We sold these terminals globally, all over the world, and the company was quite successful. We ended up taking it public along with some other companies, and once it got to that point, I decided that it's time to move on and do other things. And unlike a lot of entrepreneurs, I thought, well, rather than start another company and be CEO and do it all over again, I'll do it vicariously, and I'll invest in people like you who are doing it for the first time, and I can kind of go along for the ride. But the big difference would be that I'm not committed, you know, on a 7/24 type of basis. I would be able to kind of relax, spend some more time with my family, because when you're an entrepreneur, as you will discover if you haven't already done so, it's a very serious commitment. And sometimes, you know, you don't see your family. And when I sold my company, my wife said, well, I'd like to introduce you to our children. And so I thought, well, it'll be nice to meet them and spend some time with them. So anyway, since I sold the business back in the early 80s, I started angel investing. And I've been doing that for now over 40 years, sometimes wearing different hats, working with different organizations, but always comes down to working with startups. So today's topics, and we can kill two birds with one stone here. The idea is to engage with angel investors. How do you connect with them? How do you get them to write you a check? And also, how can you win the BC, the New Ventures BC competition? There are a lot of angel investors involved with the competition as mentors, as judges, and so on. So what they're looking for is very similar to what angels are looking for. So if you can engage with angels and if you can answer the questions successfully that New Ventures is asking you, then you're really doing just one thing but addressing two different purposes. I want to talk a little bit about the landscape we see today. There are a lot of uncertainties, and you all know about these uncertainties, largely promulgated by our good friends south of the border. And this has created problems in the market, largely uncertainties. And the impact on angel investing is that it is driving valuations down somewhat because of the uncertainties. It's also making it more difficult for you to answer very tough questions when prospective angel investors ask you, well, how are these tariffs impacting you? And maybe you don't know, maybe you don't have enough information, but it's adding to the confusion, and it is making it a little more difficult for entrepreneurs to raise capital. There's a lot more emphasis now on metrics, on numbers, and I'll talk more about that when we get into financials. It used to be just fine that you had a good idea and a good team, but more and more, and increasingly so, investors are looking for numbers. and do they make sense? Finally, AI is becoming very pervasive. It was interesting to sit at the back and listen to the previous presentations. Sean used AI to create his PowerPoint. I tried that, and in 1 second I got a really good PowerPoint presentation all about angel investing. So why have me here? I mean, you could do that yourselves. You can just go to ChatGPT and say, hey, tell me about angel investing. But I have to admit, when I looked at the presentation, it really wasn't as good as mine. So I thought, well, I'll come anyway. Maybe next year it'll be a different story. But for the time being, you're stuck with me. And I do think my presentation might be a little bit more useful than the one I got from ChatGPT. Another thing I noticed just recently, there's something called NoCap. And this is an artificial intelligent angel investor, AI, interestingly enough. And it was trained by Y Combinator. And just a couple of weeks ago, it actually made its very first angel investment. So here's this AI app, I guess you'd call it an app or program, called NoCap. And it met with a company, with entrepreneurs, went through the whole dialogue and interview process, and ultimately wrote a $100,000 check and transferred that through EFT, and the company ended up with the investment without any human involvement. Maybe you'll be in that position where you can do that, but we'll see. Just also last week there was a good webinar put out by Garibaldi Capital Advisors, a local organization here in Vancouver that works with startups and other tech companies to help them with M&A, merger and acquisition transactions. And they put on an interesting webinar called State of Tech Capital Trends in Investment and Exit 2025. And you can Google that and watch that presentation. I would encourage you to do so. Starting off, I want to, well, let me ask you, how many of you have heard of the E-Myth? Just only a couple of people. So what is the E-Myth? The E-Myth basically is the idea that many people who think they're entrepreneurs are really not entrepreneurs. They're technical people, technicians, software developers, engineers, who are really just technicians suffering from an entrepreneurial seizure. And what that means is just because you think, and just because you are, not just because you think, but because you are good at coding or development, design, doesn't necessarily mean that you can run a company that does that and build a company. And that's the big challenge for you in convincing angel investors to work with you. So a typical angel investor would ask this question. So you're a startup entrepreneur, you have no business experience, and you want me to give you money. You know, that's a stretch. So what we're going to do is, I'm going to hopefully tell you what you can do about that. Success factors, and by the way, interestingly enough, talking about AI, some of these graphics, I got ChatGPT to generate them for me because usually I plagiarize someone else's by just Googling on the web, but this time I got unique images from ChatGPT. This one here that talks about the landscape, I just said to Chat, give me a graphic that talks about the uncertainties in today's environment, and that's what it came up with. I thought pretty good that it had the White House. Anyway, carrying on, success factors. You know, one of the things that I'm obsessed with is what makes a company successful. Alternatively, why do companies fail? And that's a question that I've been pondering, or questions I've been thinking about for over 40 years. And I still don't have solid answers for those. And that's partly what keeps me excited about this business, because I'm learning every day from new ventures and how they become successes or what makes them become failures. There are really two things that I believe lead to success, and that's people and money. And actually, when you think about it, the second one, capital, goes back to number one, to the first factor, people. Because if you've got the right people and they know what they're doing, they'll also have enough capital to see them through. So you can say it's people and money, but it really is just people. And I define success as cashing in at the point where you as the entrepreneur can take some money off the table and maybe change your lifestyle, or the point at which your investors cash in and make those big returns. It's interesting, I'm studying or trying to learn Spanish, and the word for success in Spanish is éxito, which is spelled exit or éxito, which is kind of interesting. So how to avoid failure? So here's a few punchlines. First of all, you got to have enough cash. You need a good runway. And to help you with your cash and your finances, and I think Sean alluded to that, and this is what his company specializes in, is providing you with a fractional or part-time CFO. Those of you who don't have MBA-type business experience and you're not that well-versed with financial modeling and projections, get yourself someone who is. And you can recruit people who will do this on a part-time basis. Or maybe you can be lucky enough to get someone as an advisor who will work with you half a day or a day a week. But it's really important for you to have that. Also, a piece of advice, and don't wait too long in doing this, is get yourself a really good board of directors. It's hard to get a good board of directors because there's liability associated with that. If you fail and you owe taxes when you fail, your directors might be liable for paying some of those taxes. So it's difficult to attract investors who are angels and others who are also willing to be directors. However, they could be advisors, and being advisors is less onerous. And when you're attracting or trying to attract angel investors, if you have well-known names, accomplished people in your presentation, that's a selling feature. So when I see names that I recognize in your pitch, that makes me immediately more interested in hearing your story. It also gives me the assurance that they are helping you stay on track and helping you avoid failure. The final thing I'd say about avoiding failure is probably my number one point: never ever procrastinate. Because if you do, someone else will eat your lunch. I was speaking once to an audience just like this, and I asked if there's a word that's the opposite of procrastinate. Do you know the story? No. And I offered a bottle of wine to the person in the audience that would come up with something. And someone came up with the word hodiate. And that word doesn't exist. They made it up. But it comes from the Latin, and it means to do something immediately, today. Do it today, don't wait. So I like the saying, you know, don't procrastinate, hodiate, don't wait, do it today. It's interesting because when it really comes down to it, especially going back to business failures, you know, what can kill you is your competition. If you don't have competition, you don't have to worry. And the way you can beat your competition is to be ahead of them. So that means never procrastinating. Today is a great time to start a company. And as Angie will tell you, I've been giving this talk for over 20 years, slightly updated each year. And I say this each time, that it's a great time to start a company. Even when we had turmoil like back in 2007, 2008, the financial crisis, it's always a good time to start a company because opportunities don't wait. So if you're onto something hot and exciting, why put it off? Again, don't procrastinate, hodiate. Some of the advantages of starting a company, of course, for you is it beats a job. You're your own boss, and that's a great thing. Today, prime rates are down. A year ago when I talked to this audience. Prime rate was 7.2%. Now it's down to less than 5%, which is great because it means that more capital is moving into this space rather than into low risk interest rate return types of opportunities. There still is a lot of angel and VC capital, albeit investors are a little bit more cautious. One really big attractive feature for all of you is the lifetime capital gains exemption. So when you sell your business, or when angels and others who invest in your company sell their shares in your company, they can get up to 1.25 or $1.25 million tax-free by investing in a Canadian-controlled private company, which is what you're doing. That's the type of structure you would have. And that's a huge benefit, not just for you, but for family, friends, relatives, and others who invest in your company. In fact, I would encourage you, if you have family members, if they have shares, each of them will qualify for this. So if you're at the point, for instance, where you want to include parents or children, you can give them shares in your company, and they all benefit from getting this much tax-free when you are successful. The big thing here in BC, as you can see highlighted in yellow, is that the BC government will give any BC resident a 30% refundable tax credit if they invest in your company. So if I write a check for $100,000, I get $30,000 of that back regardless of my tax situation. It's as good as getting a certified check from the provincial government. And BC is the only place in the whole world that I'm aware of that offers this. Other jurisdictions will give you tax credits of some form, but they're not refundable. And that word refundable is a big deal here in BC. In the last BC budget, that just came down recently, the amount that investors can claim was increased dramatically from $400,000 per investor to $1 million. So now angels in BC can invest $1 million a year and get back $300,000 as a credit from the BC government. That's a big deal. And I used to tell entrepreneurs that, regardless of what you come up with, getting a customer, of course, is key. If you're having trouble finding someone, just go south of the border. You'll probably find someone there because Americans will buy just about anything. Now having said that, I'm not so sure that still holds these days. Now, angel investors. I believe angel investors are your best friend. Where do you begin in raising capital? Someone asked me earlier, just today, should I go to VCs or angels? I would suggest you go to angels first. Never hurts talking to VCs, but if you resonate with an angel investor, they can also help you connect with VCs. The big challenge is that angels will invest where VCs won't, and their style of investing is quite different. So once you get going and you have traction and customers and revenues, it's a good time to talk to VCs. But if you're not quite at that point, it'll be very difficult to get VCs' attention. So it's best to start talking to angels. Talk about access to capital and where you can get funding. So it's a good idea to hit up mom and dad and Uncle Harry and Aunt Sally to invest in your company, but that can only go so far. Other options are things like crowdfunding. One of the best, of course, is product crowdfunding, where you're pre-selling something that you're developing. That not only gives you some cash, but it validates your idea. So that's a good thing to do. There's also equity crowdfunding through platforms such as FrontFunder, and those are always worth looking at. Historically, we've had junior public markets. Companies that are very young can go public on a junior stock exchange, but that is sometimes fraught with other difficulties. Once you do that, you're now in two businesses. You're always selling your products or services, plus you're always dealing with shareholders, and that can be a bit of a distraction. So, what about angel investors? Now, the problem with finding angel investors is there just aren't that many. At least legally, there aren't that many. In fact, it's a little bit less than 5% of the population. And I'll talk more about how we come up with that number and what defines angel investors. However, non-dilutive funding, by non-dilutive, of course, I mean funding that doesn't take up any equity and doesn't dilute your ownership or that of other investors. And that's largely government sources. And here in Canada, we have a ton of programs and grant types of funding that available to you. One of the most popular, and you should all be using this if you're not already, is the SR&ED tax credits. Those are also, by the way, refundable. So if you're doing research and development, you can get up to about 68 to 70% of your expenditures back just by filling out forms. It's not a competition. You're not competing with others. Last year, the federal government put $4 billion into this and paid out that amount of money to technology companies that claimed these SR&ED tax credits. So if you're not taking advantage of that, you're really missing a big opportunity. I've got a website called moneylinks.ca, which helps you perhaps identify some of these non-dilutive sources. I've given you a couple of examples here that I saw in my email inbox just last week. A well-known biotech company called Stem Cell got a $49 million investment from the feds, and H-Tech, a hydrogen-based company, received $49 million. So there's lots of money out there, and there's a lot of help, especially if you're trying to get into manufacturing and scaling up. Bit of a spoiler alert. I hope you all know this, but in case you don't, it's actually illegal for you to sell shares in your company. Not just shares, but also to take debt or safes or any form of security, unless you use a prospectus, which is an expensive and detailed document. It's like a business plan on steroids with a lot of legalese associated with it. And you also have to be a registered dealer. You have to be licensed to be able to sell shares to the general public. Now, we have exemptions to this requirement, and the one that's most commonly used is what's referred to as the accredited investor exemption. And by being accredited doesn't mean you have to pass a written test or a theoretical test. It means you have to, as an investor, pass a financial test. And only investors that qualify are technically allowed to invest in your business. Now, if you take money from your next door neighbor, you might be able to get away with that. However, if they're not accredited or meet another exemption, like a close friend or family member, you won't be thrown in jail. But I can tell you, you'll be in for a rough ride when you start to raise serious money from venture capitalists, because they'll take a look at your cap table, and if the investors on your cap table haven't bought shares through the proper securities regulations, they will likely not invest in your company unless you fix that problem. So this can be a real headache for you, and it's something I would caution you about. want to talk a little bit about what's really an angel investor. So typically, an angel investor is a successful entrepreneur, someone who's been in your shoes, someone who's grown a business and sold it and now has some time and money, time and money that they can put into a new venture. Companies like yours helping you get going. And they can also be a mentor and a coach to you. Many of the mentors that are associated with the New Ventures competition are angel investors, and be good for you to attend a lot of the networking events that Angie puts on, because it's an opportunity for you to meet some of these people. Now, the technical definition of being an accredited investor is someone who's a millionaire. Now in Vancouver, that will be just about everybody by virtue of them owning a home, but your home doesn't qualify. So just because you have a home in Vancouver doesn't make you an accredited investor. So the definition is you have to have $1 million that you can put in your pocket easily, like money that's in stocks and bonds and easy to liquidate. Or if you have an income, or the investor has an income of at least $200,000 per year, or jointly with spouse, $300,000 per year. Now, I just checked with Stats Canada, and in the last year that they have data, in 2021, just around 1%, or 455,000 Canadians, actually reported income on their T1 tax returns of more than $200,000 a year. So that's not very many. And then if you take a look at the millionaires, there's about 2 million. But as I said, that includes people with property, especially principal residences that they live in. So again, that's not a very big number. So we're going to talk a little bit about how you can identify those few people that do meet the accredited test. Now, why do people who have cashed in want to do angel investing? There was a seminal study done by Rob Wiltbank at Willamette University maybe 10, 15 years ago that showed that the return to investors who are very active as angels is about 27%. Now, this study was repeated about 5 or so years ago, and that number has dropped to more like 20%. And in all of the angels that I talk to, very few are actually getting anything more than 20%. And that's, again, because the failure rates are so high. Now, an angel might get a huge return on one investment. You know, you might get 10 times your money on one deal, but for every deal you have like that, you're probably going to write off 3 or 4 investments to zero. So it's a challenge. Now, the secret behind this, and I'm not going to explain this slide, and these slides are all available, by the way, to you on the New Ventures website, so you can go through them, and if you have any questions on them, just let me know. But what I want to point out with this slide is that magic 27%, which, as I said, is now closer to 20%. So when you look at all of the investment opportunities that are available to people with money, there's real estate. Of course, if you want to start really low, you can just leave your money in the bank and get 3 or 4%. You can do GICs. You can invest in property. You can invest in stocks and bonds. You can invest in hedge funds. You can invest in speculative instruments. You can be an angel investor. But angel investing is kind of at the high end of the possible returns that are available to you through all of these different asset classes that investors can put their money in. But this is the reason why this angel activity even exists. Not just because of the returns, but of course, as I mentioned earlier, people who are successful want to put something back or give something back and help others who are going through this the first time. The term angel actually came from Hollywood, where successful and well-known stars would coach and encourage and mentor up-and-coming stars, and then, of course, Silicon Valley borrowed the term. So what are angels really looking for? Before I do that, I just remembered one more thing I want to say about this. Where the angel investors that do get close to the 20% number, what do you think is the reason why they just happen to be doing so well compared to others who aren't getting those kinds of returns?
They're getting both.
They're what?
They're getting both.
Both.
Involved.
Oh, involved. Yeah, partly. Sure, that helps. Definitely. Yeah. Yeah.
They tend to invest in a basket, so in some way we'll have it.
Yeah, that's the key. That's the key. And this study, by the way, showed that if you invested in over 40 companies, you might get returns over 20%. I know in talking to people I know personally, and I always ask them this question, how they're doing and what kind of returns they're getting. Those that have invested in just 10 or fewer companies don't do that well. I know one guy, the first 6 companies he invested in as an angel, all failed, got 0. So he put 100,000 into each of 6 companies, that's 600 grand. All of it went out the window. He says, Mike, I'm not an angel investor. I'm leaving. I'll put my money into one of these other asset classes. So that's the trick. And there aren't that many angel investors, especially here in BC, that have portfolios of more than 20 or 30 companies. Those that don't are living a very dangerous style of investing. But what do these guys want in addition to making some money? Well, they want a compelling opportunity. You've really got to excite them and turn them on. You've got to be excited about what you're doing. I remember back, it was just before Christmas, over 20 years ago, we had a physicist from UBC pitching to our VANTEC angel group, and his idea was to create energy through the fusion process. Everybody knows or knew then that fusion was possible, but it was not commercially viable. And he felt that he had some engineering ideas about how to make it viable. And he was so passionate and so excited about what he was doing that it was contagious. And it spilled over to the audience. And after making this one presentation, he raised $400,000, which was just enough to get the company started and get to first base. A couple of weeks ago, I was in Richmond visiting the facility that is now General Fusion, and they'd raised, something like $500 million since in those 20 years. And they still haven't got fusion working, but I believe someday they will. But the point is, it was just so compelling, it was difficult to not invest in it. Having you as CEO be coachable is a very important attribute. Investors don't like to deal with companies that don't listen, or at least give them the time of day. I mentioned the board of directors. They do want good returns, and that means in terms of multiples, ideally investors want to get somewhere between 10 and higher multiples on their investment. So if I put 100,000 in, you have to show me how I can make at least $1 million in somewhere between 5 and 10 years. If you can't do that, you're wasting your time. Having customers is really important, and having a good deal on a first round. What that usually comes down to, I heard questions about valuation. We can talk a little bit more about valuations. But valuations are not very scientific. They're just a negotiation and agreement. But what it usually comes down to is when you're raising money on your first round of non-family, friends, and relatives, you're going to give up something between 20 and 30% of your company, and regardless of how much you're raising, interestingly enough. So you may be looking for $500,000, $1 million, or $1.5 million, and you're going to be giving up 20 to 30%. And why is that? Anybody have any ideas to why that number just happens to always come up? No, seat on the board, no. No. It's dividing the pie, right? When you think about it, here's you, you've got your team, you've got your idea, you've got lots of energy and ideas and drive and so on, but what you're missing is the money, right, to be successful. Without the money, you're worthless, right? Your valuation is zero, right? When you start, if you need money to be successful and you don't have the money, your value is zero. So the way you get value is to add some money to the picture. So if an angel investor puts in $500,000, now you're worth something. But you're not worth the $500,000 that the investor put in. You're worth 3 or 4 times that. Because now the synergy between the money and you gives you the value, right? So that's why it just so happens that you're going to be giving up 20 to 30% on that first round. So it's not very magical. You know, you can do all this analysis on your patents and discounted cash flow and some of the things that Sean was referring to, but this is what it comes down to in the end. Let's move along here. And in terms of, yes, question?
For the valuation that you mentioned about 20 to 30%, is the percentage actually dependent on the round that you're raising? Because let's say someone didn't raise in the seed round but went directly to Series A. So would that percentage, would it be still be consistent with 20 to 30%?
In fact, what's interesting is on each round, you're giving up 20 to 30%. So on your seed round, you'll do 20 to 30%. Then on your Series A, you'll dilute another 20 to 30%. But the price per share is much higher, right? So you're getting a lot more when you on those subsequent stages. So the idea is on your seed round, you raise enough, you know, raise what you need, but don't raise too much. And then on your A round, once you hit some milestones, then you can raise a lot more, but you're still giving up 20 to 30%.
Angel investors in BC issue convertible notes as well?
Yeah, convertible notes. Yeah, we could talk some more about that. Yeah. And so you're going to be offering angels co-ownership. You're going to maybe offer them some kind of participation. Perhaps they'll be on your board of directors, which is a good idea, or maybe advisors. And of course, that return. And you have to show them how they can get these multiples. And just by way of some arithmetic, a 10 times multiple in 10 years is a 26% return, annualized rate of return. But remember, that's just on your company. Keep in mind that they've got a portfolio of a few dozen additional companies, so they're not going to get anywhere near 26% just through you, right? You're going to be the winning company, but they're going to have a few losers. So you actually have to show them how they can get a higher return than just 26%. And when investors evaluate your proposal and they look at the potential return that they might get, they always convert it back into IRR, internal rate of return percentages, because it's the only way that they can really compare investment alternatives. You know, having just the multiples, if you say, well, you get 5 times or 10 times, that doesn't mean anything unless you specify the time that it takes to get those kinds of returns. When you engage with an angel investor, or with any investor, VC or otherwise, there's a very popular instrument called the term sheet. And this spells out the terms and conditions of the investment. And there's too much information here for me to go over now, but there's a lot of published information on term sheets. You can go to some of my websites and read about this and learn about it. But it's a starting point in your discussions with an angel or other investors. The number one thing on the term sheet, of course, gets back to the valuation. And we've already talked about that a little bit. And we'll talk about it a little bit more. So as I mentioned, the valuations today compared to last year or the previous few years are dropping slightly, again, partly due to the uncertainty in the markets. I've highlighted here the fact that entry valuations, your valuation today, is really driven by the potential exit valuation. So the best thing you can do is to show an investor how much your company is going to be worth when you have an exit. And that's much easier to do than trying to come up with a valuation today. Because when you exit, you will ostensibly have revenues, you'll have bigger team, you'll have lots of customers, and it's much easier to come up with a range of exit values. A good way of doing it is by looking at market comparables. Just as in real estate, when you're buying and selling houses, you look at other houses that have been bought and sold. You do the same thing here. You look at other companies, especially in your industry sector, that have been bought and sold. And there's a lot of activity. Going back to what I mentioned earlier about Garibaldi Capital's webinar last week, they have that kind of information, and they're happy to give it to you. There's a company in Seattle called Corum, C-O-R-U-M, and they specialize just in software, all kinds of software companies, and they can give you some pretty good ideas of what your company is worth given certain metrics, like sales, for example, the market that you're in, and so on and so forth. So it's easy to get these exit values, and then you bring those back to a present value, and that's how you can determine a reasonable starting point for bringing investors in. And I just mentioned here in the box that we've got some pretty good exits in BC in the last little while. Up until 2021, there weren't any so-called unicorns, companies that were valued at more than $1 billion. So it's really fantastic to see this kind of progress in British Columbia. It's also good because it attracts investors to BC from Silicon Valley and elsewhere. Somebody asked the question, I think, of Sean in the previous presentation about attracting money in your own backyard or attracting angels elsewhere, and having these kinds of local success stories really helps a lot. This chart here just shows from NACO, the National Angel Capital Organization, sort of the range of values and what median valuations are being seen in our current marketplace. I want to give you just a quick valuations example, and something again to keep in mind when we talk about 10 times or 20 times or 100 times returns. 10 times today, 10 times on my investment today doesn't mean I'm going to get 10 times when you cash in. And here's why. And this is an actual example. It just so happens that this company, I won't name it, was a New Ventures BC winner a few years ago back. I think it was in 2019. Actually 2018, sorry. So they had a valuation of $1.5 million in 2013. So that was pretty attractive. It wasn't that hard to get investors in at that kind of an evaluation. They sold to an American company in 2018 for $26 million, which is 17 times. So you think, oh, 17x, that's great. That's got to be well above 30% IRR. But investors actually only got double their money. And that's because the company had to do multiple rounds. It wasn't just a single round that got it to be successful. In fact, this company did 8 or 6 seed rounds. And they did those rounds at just similar valuations per share or slightly higher, but they had to do lots of these subsequent financing rounds, which meant a lot of dilution. So investors that got in on your very first round really didn't get anywhere near 17x, they got 2x. So you've got to keep that in mind too. And investors are thinking about that when you tell them 10x in 10, they're going to say, yeah, but how much more money are you going to be raising next year and the following year to actually get you to the point where you're going to sell out and get that home run? Now, I just saw this in my email in basket, and I thought I'd tell you about it because on April the 8th, some well-known local people are giving a presentation on managing the cap table. And I think this would be worthwhile for you to look into if you don't know about it already. And cap tables are very important because they define your ownership. And as I alluded to in my comments on securities regulation, you want to make sure that everyone on your cap table has received their ownership or their shares through proper securities regulations. When you're attracting angels and other investors, it's common to offer shares, usually common shares, although in the US it's been more typical for angel investors to ask for preferred shares or something like convertible notes. And through one of the accelerators in Silicon Valley, Y Combinator, which I'm sure many of you have heard about, something called the SAFE has become very popular. SAFE is basically a simple agreement for future equity. And it worked very well in Silicon Valley because at these accelerators like Y Combinator, it's fairly certain that companies that go through that process will at some point attract venture capital. And so the idea was that instead of arguing about what a suitable valuation might be, the idea is, well, let's not worry about valuation. Let's just get some money, do a good job, get to the point where you can attract serious capital, like maybe instead of $1 million, 5 or 10 million from VCs, and then at that point in time, your SAFE will be converted into equity at a discount because you took that earlier risk. So instead of getting the same deal that VCs are getting on the A round, you as the investor will get the same thing but 20% more, say 20% more shares. And that works well in an environment like Y Combinator, but it doesn't really work well in other environments, like here in BC. So BC angels, generally speaking, don't like safes. There are some people, there are some exceptions to that. And one thing, by the way, that you should keep in mind in talking to angels, unlike VCs and bankers, angels are people like me and previous speakers that you've heard who all think differently and who all have different styles and objectives and risk propensities. So you'll get a lot of variation and you'll find that some will like a certain thing like safes, but generally speaking, most don't like safes. And I've done a little diatribe on this that I've highlighted in yellow here. I've come up with something called a safety, which is a simple agreement for future equity today. And you can read a little bit about that if you're interested. So, how do you find angels? Well, angel investing has, in the last decade, become a global phenomenon. I've been to angel, Dragon's Den type pitch sessions all over the world. I've been to angel events in Australia, in India, in Dubai. It doesn't matter. They all are very homogeneous. They're very, very similar, and the styles and the mannerisms, etc., very, 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 very similar. It doesn't matter where you are. But here in Canada, we're lucky, and here in BC, we're even luckier. We've got in Vancouver, for example, four very active. There are probably some other smaller groups, but there's four fairly active places you can go to meet up with angel investors. We have VANTEC, we have the Keiretsu Forum, we have Angel Forum, and we have Startup TNT, and of course, we have New Ventures BC. Great way to meet with angel investors. I'll tell you a little bit about VANTEC, which is a network that I started up back in 1999. So we've been going for many, many years now, and we meet every month, and we hear pitches from people like you, and we raised a lot of money for companies that have come through this particular venue. Our next meeting, just coincidentally, happens to be next week on Wednesday, and if you're interested in joining, you can join online, easy to do, and it'll give you a sense of what happens and the kinds of questions that angels are asking. You'll also hear what entrepreneurs say about valuations and how they make their case to investors. So I would invite you to do that. If you'd like to, pop me an email, and then that way I can give you the link and you can join the party. And then we have recently the occurrence, or the emergence, I should say, of angel funds. So in addition to having single individual investors, we now have a situation where a bunch of investors have decided to work together, pool their capital, and do this on a collective basis. And this helps address that earlier problem of portfolio size. By angels working together and pooling their capital, it's easier for them to develop and build portfolios of, say, 30 or 40 companies rather than just half a dozen or so. So that's one of the reasons for the creation of these angel funds. It's also a way to invest more. So a lot of angel investors, especially here in BC, might only invest $25,000 or $50,000. And that doesn't give them really any kind of clout where they can drive a hard bargain with you. They're basically following a term sheet that has already been defined. But it's very unusual for an investor to call the shots if all they're putting in is $50,000 of, say, a $700,000 or $800,000 round. But an angel fund, by investing not just $25,000 or $50,000, but more like $100,000 to $150,000, they can actually do a term sheet. And one of the things we do with What If is we can lead a term sheet. So if you're having trouble getting to the starting point and getting that very first investment proposition through a term sheet, we can, for example, do that. So What If is another fund that I started in 2003. We give tax credits to investors, so that makes it easy for me and the fund to attract investors. We've done 150 investments. Quite a few new ventures companies are in our portfolio, and we've had a pretty good return. We've actually been hitting around 16, 17%. So we're doing well enough to stay alive and stay in business, attract more investors, and work with companies like you. So in terms of making the business case, getting back to this and the subject matter of New Ventures BC and what it takes to win, it really comes down to, what are you selling, and who are your customers? Who's going to buy it, and why are they going to buy it? And most importantly, how are you going to make money? The big mistake that a lot of entrepreneurs make is they're enamored with their technology, and they talk a lot about their science or their technology rather than the customers and why and how they're going to make money. So you should really focus on that. You've probably by now seen a lot of presentations on elevator pitches, and you've seen things like this where you have to very succinctly and just a few sentences explain what it is you're doing. The trick here is for you to say what you're doing so that I, as the listener, have a picture in my mind of what you're doing. If you use a lot of fluffy words like we have enterprise solution software that help manage our workflow, that doesn't mean anything to me. It doesn't form a picture. So if you can say something very succinct like this example here, we, Ace Corp, we're making a personal GPS tracker, so I can visualize it. Who's it for? Well, parents are going to use it. They're going to use it to track their children. And this gives them information that's valuable, and they can keep tabs on their kids. So I have a picture in my mind. Now I know exactly what you're doing, and that will tell me whether I should spend more time with you or say, well, I'm just not interested in that. Now, what's more important when you're talking to angels than the elevator pitch is the investor pitch. And this is one you probably haven't seen. And it's very similar, but it addresses the investor and what the investor stands to gain by working with you. So again, just fill in the blanks. So using the example from before, we, Ace Corp, we need $500,000, and it's mainly for production tooling, hiring sales staff, and in return for that, we're going to give you, as the investors, 20%. Our plan is to be acquired by Polycom. Note that I'm very specific here. I'm not just saying acquired by company X. I'm giving a specific case because I've done my homework. I know that a company like Polycom might buy me if I'm successful. So Polycom is going to buy me for $15 million in 2029. That would give a 6x return, which translates into an IRR of 35%. So if you can say something like that, that will clearly get the attention of a potential angel investor. Now, talking about fluff and using juicy words and stuff that doesn't resonate, just for fun, when we have these angel meetings, we occasionally play what we call Angels BS Bingo. And it looks like this. So if you stand up and you make a presentation and you use a lot of these buzzwords, well, we're a world-class company and we've got the best of breed artificial intelligence technology, blah, blah, blah. When investors hear these words, they make a little X, and if they score a straight line, then they say bingo, and you have to sit down and shut up. So we do this kind of as a bit of a joke, but the message to you is avoid these fluffy terms. Avoid BS and just be as specific as you can. Now, getting back to the competition, is New Ventures all about coming up with a business plan, or is it really about the business itself? Well, the answer is it's really both, because it's the business that matters, but it's your plan and the answers to those questions that Sean referred to that explain what you're doing. The judges have been told, and I don't think we've changed this, have we, Angie? This has been the message to judges since New Ventures got started, and it's to pick the company that's most likely to be commercially viable. So number one, it's going to get some commercial traction, but it's also going to be ultimately of the greatest value. So you may have something that's a slam dunk, but it might be a modest endeavor. On the other hand, you may have something that's risky and have a lot of value, but just how risky is it? So this is putting a lot of judgment into the hands of the judging panel. And I think there's 10, right? 10 judges, give or take. And so they have to interpret this, but they're going to be looking at this largely, I believe, the same way that a lot of individual angel investors look at it. And the question that they're going to be asking too is, are you going to get to the point where this is making money, cash flowing, where you don't need to raise any more money? And is it going to scale and grow? And growth is very, very important. If you have a business that's only growing 5 or 6% a year, it's not going to turn anyone on. It's got to be growing 15, 20%, preferably 50 to 100% a year if you want to get the attention of investors. And then speaking of scale, this is a really important thing for you personally. This is a personal thing for you to think about. What kind of a company do you see yourself building? Is this going to be, you know, $100 million revenue type of company? Or is it going to be what we refer to as a lifestyle business, where you're doing it really because you want to be self-employed? You know, you want to be your own boss. You're going to have a nice, good company, but it's maybe going to get to $10, $15 million a year, not $50 or $100 million a year. Both are fine, no problem. And you can get investors in both types of company. But the important thing is to figure out what you want to do and then sell your vision or your dream to the investors. If you think that investors want to hear about the $100 million business and you're putting a square peg in a round hole, that's just not going to work. Just be as honest as you can with what you want to do, and then find people who buy into your dream and your objectives, and you will find support. A lot of it comes down to P&L, and you all know that P&L means profit and loss. But equally important for investors at this stage is passion. You know, as I mentioned with the UBC physicist, how passionate are you about what you're doing, and your leadership capabilities. Do you have the ability to lead this team? And if you don't, what are you doing about it? So you got to have both things. Now, round number 1 in the competition is the idea. And this is due, as you know, on Monday, midnight on Monday. So if you haven't put that in, you've still got 2 days roughly to work on it. And it's just a one-pager explaining your idea. And then round 2, that's a little bit lengthier. It comes to 5 pages. This is due in about 3 weeks later. And out of that, 40 companies will be selected to move on in the competition to the next round. And correct me, Angie, if I got any of this wrong. I just updated the dates from the website. And then we have Pitch Day in June, and that's where 25 companies pitch, and 10 will advance to round number 3. And then round number 3 is where the venture plan is presented, and that's really just an 8-page condensed business plan, and that's due at the end of July. And then round 4 is when the top 10 are selected and present at a finale, and that takes place on September 11th and 12th over 2 days. And then the judges deliberate, and it's party time on September 29th when the awards are made and the winners are announced. Now, during that whole process, of course, getting from now to September 29th, whether you win or not, a big advantage of participating is making those connections with mentors and individual investors, i.e. angels, that can help you with your dream. So, business plan. Let's talk a little bit about that. You know, business plan is better than a forecast. A lot of people mix up those two things, but by having a plan, it means you have determined how you're going to get your revenue. And explaining how you're going to get your revenue is what is important to investors. And the new ventures questions can help you start putting some meat on the bones and developing a comprehensive plan. Now, I noticed when Sean did his presentation that the rules have been updated a little bit, Angie, and when I last gave this talk, there were 9 questions. I think we're now up to 12, right? When I looked at the rules page on the website, it had a few additional ones. So I thought, oh, I'm giving out incorrect information here. So what I would encourage you to do is check out that link that's highlighted here in yellow, And that explains what you have to submit during this year's competition. But the points that I've got on this slide are still relevant, except you'll have to add a little bit more to it than what I'm going to cover. So let's talk about the first question, the product. This is, what is it? What does it do? Explaining that. One of the companies that I think they went through the competition and we invested in them was Nerio, led by a female entrepreneur out of UBC. It was successfully sold for about $70 or $80 million to Generac in the US. And this is where they started. They were making energy management systems, and they obviously were able to explain what they were doing well enough to attract investment. Intellectual property is important. That helps you develop a moat or barriers to entry for competitors. So describing your intellectual property is important for investors. It doesn't have to be patentable. It could be trade secret or something along those lines. Just know-how is valuable, but describing it is important to investors because they want to know what gives you that advantage. For fun, I mentioned our angel fund, What If. There happens to be a Netflix series called What If. Has anybody by any chance seen it? So Renee Zellweger stars in it. And if you want a bit of a break from working on your business plan and some amusement, watch this Netflix series because it's actually very, very close to what happens in terms of venture capital and startup investments. And it's a story about how the VCs screw the entrepreneurs and how the entrepreneurs are able to retaliate and maneuver around the VCs and beat them at their own game. And there's some interesting lessons about intellectual property in that series. So if you want a little entertainment and knowledge at the same time, watch that series. So tech development, I won't spend a lot of time on this, but in your new venture submission, you want to have a time frame. You want to explain what the time frame is for doing your development, because it speaks to cash flow and when you might need additional funding. Fourth question has to deal with the status of your business plan. Where are you in nailing that down? And the most important question, in my humble opinion, is your market. Who are you going to be selling to? And lately I've seen lots of presentations that have this slide in them, this TAM, SAM, SOM stuff. And as you can see by my sarcastic comment on the bottom, I say TAM, SAM, SOM equals SPAN, because I don't think this is a good slide to put in your presentation. Now it's interesting, just as a check on my own sanity, I did a bit of Googling, and many VCs actually like this, especially the ones that are looking for the unicorns. Okay, but let's face it, not everyone's going to be a unicorn, and angels aren't necessarily looking for unicorns as VCs are. That's another big difference between angels and VCs. I've made a lot of money by investing in companies that exit for $30 million, right? If I put 100,000 in a company that exits for 30 million and I get $1 million back on my 100, I'm a happy camper, right? I don't need to have just unicorns. And the beauty about angel investing is if you can't demonstrate unicorn potential, it doesn't mean that you've eliminated investors. You may have eliminated a lot of VCs, but you won't have eliminated angel investors. And I can tell you, many angel investors think these TAM, SAM, SOM slides are BS. And you saying, well, we're developing this device that's part of a multi-billion-dollar market doesn't mean anything, because what's important is what's your market niche? What is it very specifically that you're doing, and who are the competitors in your field, and how can you dominate that field? How can you be not just 1%, because nobody wants to invest in a company that's going to be 1% of something. I want to invest in your company if you're going to be 60 or 70% of that market that you're dominating. So the key here, and as you can learn this from Regis McKenna, and that's what put Apple Computer on the map, is defining your market and saying this is my market and being very specific about it, and then dominating that market so that you own it. So he talks about owning your market, and that's music to an investor's ears. And the difference between angels and VCs again is you may be dominating a $100 million market, where the most that can be captured is $100 million. That'll never be of interest to VCs, but it sure as hell is of interest to angels who can see you exiting at 3 or 4 times your revenue multiple and giving them a heck of a good rate of return. And the other thing I highlighted in yellow here is never ever say that, gee, you know, this market is so big that all we have to do is get 1% of it. Like, why 1%? Well, why not 10%? Why not 0.5%? It's a totally meaningless statement. So don't get caught in that trap of saying all you have to do is a little bit of a big pie. Doesn't work. Distribution is important. You know, how are you going to get, especially if you're doing something with hardware, and if it is hardware, of course, now with the tariff uncertainties, that's a big problem. But you still have to deal with it. You have to talk about how you are going to get users to buy. Is it direct web sales? Are you using distribution? Are you using retail channels? You know, addressing this is very important. Competition is very important. I worry when I see a presentation that says, oh, we're so advanced, we don't have any competition. Well, you know, your competition is always the status quo, and if you can't find anybody by Googling, make something up, because there is competition. I always like to Google when somebody, like during a pitch, I'll sit at the back and they'll say, well, we're doing this and that, and I'll just ask chat or do some Googling, and I'll find half a dozen companies that are doing almost exactly what the presenter is talking about, right? That makes me very nervous, because if they don't know about this competition, and I found it in 2 or 3 seconds by Googling, that's not good. So you got to know who your competition is, and don't be afraid of the competition. When I was building my business way back in the 70s and early 80s, I remember going to this conference, and all my competitors were there. And I got to know them really well. And I remember driving around in Acapulco in a Jeep with one of my biggest competitors. I was the driver, and I was making him a little nervous with my driving. And I started asking him questions about his customers. And he said, well, I don't know if I want to answer all those questions. And I said, yeah, but I'm in the driver's seat. Now that's, I'm being a little bit humorous, or trying to be humorous by telling you that story. But the important thing about that was I got to know these competitors, and I learned what their market definition was. What piece of the pie were they going after? Were they focused on universities, or were they focused on industries? And you know, there was a difference there in terms of what the customers needed. And by me knowing, okay, this company is going after these customers and this one is going after those, I could change my strategy. And so what I did, for example, is I went after largely foreign markets. This business that I was in was an exploding business, and very highly competitive. Like, I had dozens of competitors, but they were all going after the same customers. And I found big opportunities in Sweden, Finland, Japan, Korea, and I went after those customers. You know, we developed character sets that weren't available in those days. Now, of course, you have it. But back in those days, having the Hangul characters on a Korean display terminal. Nobody did that. And that's what we focused on. And so we dominated that market. We owned that market. We were 80, 90% of that market. And it was all by getting to know our competition and learning about their strategy. So it's good to know your enemies. Team, your team, very, very important. You know, what are the strengths of the people that are working with you? What's their previous experience? What attributes, what skills do they have that will ensure your success? Very important, and don't be embarrassed about this, especially when you're really still very young. We all have weaknesses and we all have shortcomings, but don't be shy about telling investors what those are and perhaps what you're going to do about them. Maybe getting mentors, maybe getting that part-time fractional CFO that we talked about earlier. So identify those shortcomings and explain what you're going to do about those. Now we get to the financial part, and this is about metrics, and it's about numbers, and it's about money. And your marketing plan and all those other things in your business plan all lead to the dollars and cents. You can't get to this without doing the other stuff, without knowing your customers and who's going to buy and so on and so forth. But all of that other work is going to help you ultimately produce your financial forecasts and your financial statements, and most importantly, your revenue projections. Many companies think that the investors want to hear very ambitious sales forecasts or sales numbers. And it's not unusual for me to hear pitches where people say, well, we're going to get to $50 million of revenue in 5 years. Out of all of the companies I've invested in the last decade in BC, very few have achieved that. Quite a few have said they do that, but very few have actually achieved that. So on the other hand, if I hear a presentation where you say to me, okay, we're going to get to $3 million in revenue in year 10, oh, that sounds kind of unexciting. So there's some balance in there. Somewhere there's a number that you can achieve that is sexy enough for me to buy into. And that's a bit of fine art. So this is not science. This is where experience. This is where mentors and directors can really help you nail down a serious and achievable sales projection. Again, just this week, in my email in basket, I saw this from an organization called VC Corner. And you can go on ChatGPT and just ask ChatGPT about 14 key startup metrics, and they'll explain all of these things. I'm not going to go into them, but I have highlighted some in yellow here. Most of these metrics, it so turns out, apply to SaaS companies, and they would not be relevant to biotech or clean tech or hardware type companies. But the yellow ones are. The yellow ones are universal, and that's your burn rate and runway. You know, how much money have you got, or how much money are you raising from angels, and how long is that going to last before you run out based on your monthly cash flow? What's your growth rate? I already told you that a growth rate less than 10% is boring and unexciting. And your margins. What are your margins, gross margins? What does it cost to sell whatever it is you're selling? And is that an attractive margin relative to the industry? And cash flow, because you never want to run out of money. I'm not going to belabor the illustration. You can look this up on your own. But what I did here, I've done two cash flow scenarios with two only slightly different assumptions. And one of them shows that, the first one at the top here shows that you need $106,000 of investment to achieve the revenue in this business plan. And the other one shows you need $750,000. And the only thing that has changed is the assumptions around when you're going to get paid or when you're going to pay your suppliers. That's all. The top line, the revenue numbers at the top, the sales, are the same in both scenarios. So you have to do this kind of modeling to know what your worst and best case requirements are for cash. Because the worst thing that can happen to you is running out of cash. And when you run out of cash and you're desperate, it's going to be very, very difficult to get investors in because they'll know you're desperate. And even if they like what you're doing, you're going to take a beating, especially on valuations. And you're going to end up doing what we refer to as a down round, where instead of selling your shares at $1 a share, you're selling them at 10 cents a share. But you have to do it to survive. So a couple of summary slides here, and then we can do some more Q&A. Why do companies ultimately get funded? So it's because the people, you, are credible, you're realistic, you know what your shortcomings are, and you're not afraid to admit what they are. You've got a good team, you're in control, again, leadership, and because you're liked. And when it really comes right down to it, attracting an angel investor is a lot like a marriage. It's like, because that's what you're doing, is you're getting married to someone and you're going to be stuck with each other for quite a while until you have an exit, positive or negative. So I don't know of too many angel investors that will invest in a company, no matter how good it looks, if they don't like the investors. If the investor is, or if the company, the entrepreneur is, arrogant or a bit, full of themselves, maybe have a little bit too much hubris. We've had a few companies where the founders are a bit on the sociopathic side, and these things are all very important because it comes down to a relationship, and I can't emphasize how important that is. A few final tips. Again, don't say you're trying to get 1% of any market. It's the kiss of death. Don't tell investors what you think they want to hear. Tell them what you want to do. Avoid a little bit of BS. Be humble about what you're trying to achieve. Show how you can lead the team towards success. And of course, my favorite, odiate. So, time for a few questions. Yes? We covered a lot of material there, and the slides are very busy, but they're all available to you, and I thought, well, you can read them. I've tried to, unlike many slides where you just have a lot of bullet points, I've tried to put enough there that you can kind of understand it and follow what I'm saying. And if you go to some of the support materials on the different websites that I've referred to, you can fill in and get the information that you might need. So,
three questions. I ask first one, and then if you have time, I would like to ask more. So you say don't say 1% of a big market. Let's say we have a niche market. How would we say what is the percentage of that niche market that we are going to acquire? Like where that I say it's like always guesstimation, but where would we get that guesstimation?
Well, you have to do a little bit. I like sort of the approach where you say, okay, here's what we've got, and here's how we're selling it. Now, if everyone that's a potential customer bought it, what would be our total revenue, right? And now everybody who's in that market may not be able to afford it or whatever, but it gives you a top-level number. That little booklet that I wrote called Making the Business Case explains how you can do that, okay? And it's sort of an approach where you just look at the audience and you make some assumptions about if everybody bought it, this could be the maximum market size. And then the question is, how much of that are you going to get? If it's a $100 million market, do you think you can get 20 million of it? Well, that would be 20% then, right?
You mentioned many times that board of directors are very important, and you also mentioned it is important because when you see a pitch deck, you see who are other people are involved in this. So what if you have, like we have some other people, well-known people in the tech industry, but there are mentors, advisors, not a part of board of directors? Is that enough, or you want them to be, like, I mean, by you, I mean angel investors. Do they want them necessarily be a part of board of directors?
It helps. Having them as advisors certainly helps a lot. Having them as directors is just better, right? Because now as directors, they have a bigger commitment. As advisors, you know, it's kind of casual. You phone them up if you want some advice. They may or may not be available. But as directors, they have an obligation. And by the way, if you get them in as directors, you have to treat them well too. Don't bring in directors who are just doing it as a favor. Bring in directors who have hopefully or may invest in your company, or directors that you've compensated. And don't be shy about compensating directors. Maybe give them options or some founder shares in the company. But get that commitment, get that connection, and the stronger that connection is, the better.
All right, thank you. One question, two things. So I saw two numbers up there. One was about the 20-30% from the angel investments. It's common how much they take. The other is 0.5% of the companies in BC gets to 50 millions. So were those statistics coming from, let's say, you know, heavily biased towards one specific market, maybe software, because that's something I see a lot in BC, or those are the numbers from a well-sampled variety of industries, and they all seems to fall in that back?
Yeah, those I wouldn't even, well, except for the one that talked about, you know, 0.5% of companies getting to 50 million in sales. That was, I actually took that from some US government websites where they were tracking the performance of companies. So that one you'd call a statistic. The 20 to 30% for first or for rounds of investment, that's not really a statistic. That's almost more of an observation that I've made in just looking at hundreds and hundreds of companies.
This is something I've seen before, and you mentioned it at the beginning that the capital gains exemption has increased to 1.25 million for individual shareholders. I know people who have structured, and maybe this is illegal, I actually don't know, a way to pay their salary or like pay themselves as founders of the company using the capital gains exemption. Is that legitimate?
Totally.
So you can pay.
So yeah, I'm glad you asked that question, because here's what you do. You know, let's say you want to bring someone in, well, as an employee or partner, and you don't have enough capital or cash to pay them, and you want to attract them by giving them some founder shares. You can say, well, okay, over the first year you're going to be contributing. Let's say you'd pay them to recruit them, you'd pay them a market wage of, let's say, $100,000. And let's say you're also looking for investment capital at $1 a share, right? So you say to that individual, well, we could give you 100,000 shares instead of paying you $100,000 in cash. But you've got to do that over the first year, right? So now you're giving them $100,000 worth of shares instead of giving investors the $100,000 shares, getting $100,000 in cash and giving that cash to the employee. You've cut out the middleman or the angel investor. Just as a little sidebar, this is what I did with a company that you've probably all heard about called Research in Motion, which is the BlackBerry guys. I did a term sheet with them back in 1986 where I would invest $30,000 for 15% of the company. The company's valuation was $200,000, right? And long story short, I said to the founder, cut me out as the middleman. Give them the shares and instead of a paycheck. Many years later, I bumped into the founders that got these shares, And I said, what are you doing now? He said, oh, well, we just donated $100 million to the Art Society of Waterloo. So they made gobs of money. They were billionaires by taking equity instead of a paycheck, right? And so you, as the founder, can bring in other people and deal them in that way. And it's totally legitimate. Now, you have to be careful. You have to get some good advice on it, and I can point you in the right direction. But it's totally above board, and it's a common practice.
Is this on? Yeah. So similar to you know, the financial funding side of things. So you know, the 30% that rebate that investors can get back. Do you ever see, or is it even legitimate for an owner to obviously secure the 25% or 25,000 to get the, what is it, the EBC registration, and then invest further? Like, can the owner actually
No.
invest in their own company?
It depends on the ownership, right?
Yeah.
And it has to do with percentages, but the guidelines are pretty clear.
Okay.
But if you're a majority owner, no, you can't do it. But your parents could, or your kids could.
Yeah.
No problem there. So you just you get around it that way.